Most financial stories announce themselves loudly. Prices surge, headlines follow, commentators argue, and attention arrives all at once. But the most important market events often begin quietly, far from screens, far from social media, buried in reports that almost nobody reads. In late 2024, one of those quiet signals began to appear in the global silver market. It didn't look dramatic at first. No panic, no sudden price explosion, no emergency statements. Instead, something far more subtle happened. Physical silver began leaving exchange vaults at a pace that had not been seen in decades. Not moving between accounts, not being reclassified, leaving entirely. To understand why this matters, it helps to understand how modern commodity markets actually function. Most people assume prices reflect supply and demand in real time. In reality, prices often reflect expectations, contracts, and financial positioning, rather than immediate physical availability. Silver, like many commodities, is traded primarily through paper instruments. Futures contracts, options, exchange-traded funds, certificates, swaps. These allow participants to gain exposure without ever touching the metal itself. As long as most participants are willing to settle in cash rather than request delivery, the system operates smoothly. But this structure depends on a crucial assumption, that physical metal will be available if and when it is needed. When that assumption weakens, the system begins to behave differently. Throughout October and November of 2024, registered silver inventories at major exchanges declined rapidly. These were not accounting adjustments. Registered inventory refers to metal explicitly designated as available for delivery against futures contracts. When registered inventory falls, it means less metal is immediately accessible to meet contractual obligations. This does not automatically indicate a crisis. Inventory levels fluctuate. Withdrawals can occur for many reasons. But the speed and scale of the decline raise questions among those who track such data closely. At the same time, price behavior told a curious story. Silver prices did not surge in response. Instead, they remained relatively subdued. In many markets, this combination, falling supply with stable prices, signals intervention, delayed response, or structural friction. Another signal appeared in the futures curve. Under normal conditions, futures prices trade above spot prices. This reflects storage costs, financing, and the value of time. When spot prices rise above futures prices, the market is said to be in backwardation. Backwardation is rare in precious metals, especially silver. When it occurs, it suggests that immediate delivery is being valued more highly than future promises. In practical terms, it means some buyers are willing to pay a premium to obtain silver now, rather than wait. Backwardation does not last long in well-supplied markets. It appears when confidence in future availability declines. This was not happening in isolation. Across Asia, subtle policy changes were underway. In some countries, banks reduced or suspended retail sales of physical silver. In others, regulatory classifications made it more difficult for individuals to acquire precious metals through traditional banking channels. These were not dramatic bans. There were no press conferences. Instead, they appeared as internal policy shifts, risk reclassifications, or temporary suspensions with no clear end date. In India, meanwhile, silver imports surged. Demand rose sharply as households, manufacturers, and investors increased purchases. This pattern has appeared repeatedly during periods of currency volatility, when trust in paper assets weakens. Individually, each of these developments could be dismissed. Markets are complex. Policies evolve. Demand shifts. But taken together, they suggested something broader. Physical silver was becoming harder to source. Not because it no longer existed, but because available stockpiles were being drawn down. To understand why silver behaves this way, and why it has repeatedly emerged as a pressure point during periods of monetary transition, we need to step back far beyond the present moment. Silver's role in the global system did not begin as an industrial input. It began as money. For thousands of years, silver functioned as one of humanity's primary monetary metals. Long before paper currencies, long before central banks, silver coins circulated across empires. They facilitated trade, stored value, and anchored economic systems. Silver's appeal was practical. It was abundant enough to support daily commerce, but scarce enough to retain value. It could be divided, minted, verified, and transported. For much of history, silver did what money is supposed to do. That role began to change in the modern era, particularly in the 19th century. As industrial mining expanded, new silver deposits were discovered. At the same time, financial systems were becoming more centralized. Governments faced a fundamental decision, whether to maintain a monetary system anchored to multiple metals, or to consolidate around a single standard. In the United States and much of Europe, that decision favored consolidation. In the 1870s, legislative changes effectively removed silver from its formal monetary role. The shift was framed as modernization, but its economic consequences were profound. Limiting the monetary base reduced inflationary pressure, credit became scarcer, debts became harder to repay. This was not an abstract debate. It had real effects. Farmers, small business owners, and debtors suffered under deflationary conditions. Creditors and financial institutions benefited. Silver became a political issue. Campaigns were fought over it. Speeches were delivered. Movements rose and fell. But the outcome remained unchanged. Gold became the dominant monetary anchor. Silver was sidelined. Yet silver did not disappear. It remained embedded in coinage, reserves, and everyday transactions. For decades, silver coins circulated alongside paper currency. But the contradiction grew. As economies expanded and currencies were issued in greater quantities, the metal backing them became increasingly strained. By the mid-20th century, the tension became unsustainable. Rising silver prices made silver coins worth more as metal than as money. Governments responded by removing silver from circulating coinage. Strategic stockpiles were sold into the market to suppress prices and maintain stability. This period coincided with a broader transformation: the rise of fiat currency. Money was no longer redeemable for metal. Instead, it was backed by policy, confidence, and institutional credibility. In such a system, precious metals became indicators rather than anchors. Their prices reflected confidence in currency management. Rising metal prices suggested inflationary pressure or monetary instability. That made them inconvenient. As financial markets grew more sophisticated, a new solution emerged. Metals could be traded on paper. Futures contracts allowed participants to hedge, speculate, and manage risk without moving physical metal. Exchange-traded funds offered exposure without storage. This created liquidity. It also created distance between price and physical reality. The system worked as long as physical supply exceeded demand, and most participants preferred cash settlement. For decades, that condition held. Silver prices remained relatively stable. Industrial demand grew gradually. Stockpiles absorbed fluctuations. But systems built on surplus behave very differently once surplus disappears. And that is where the present moment becomes relevant. To understand why silver periodically becomes a stress point, it helps to understand how modern commodity markets actually manage scarcity. Most commodities are consumed. Oil is burned. Wheat is eaten. Copper is embedded in infrastructure. Silver shares this trait, but with an added complexity. It is consumed in ways that make recycling difficult or uneconomic. Once silver is used in electronics, solar panels, medical devices, or industrial coatings, much of it disperses. Recovery is possible in theory, but rarely practical at scale. Over time, this leads to permanent loss from above-ground inventories. Gold behaves differently. Almost all gold ever mined still exists. It is stored, recycled, and preserved. Silver disappears. For many years, this distinction did not matter. Mining output exceeded industrial consumption. Government stockpiles accumulated. Exchange inventories grew. But as industrial demand accelerated in the 21st century, the balance shifted. Electrification increased silver usage in electronics. Renewable energy expanded demand for photovoltaic cells. Medical technologies relied on silver's antibacterial properties. Defense and communications systems incorporated silver for reliability. At the same time, mining output faced constraints. New deposits became harder to find. Environmental regulations tightened. Political risk increased in key producing regions. Investment in new mines lagged demand growth. The result was a persistent supply deficit, not dramatic in any single year, but cumulative over time. For several years, that deficit was met quietly. Existing stockpiles filled the gap. Government reserves were drawn down. Exchange inventories declined gradually. Because prices did not explode, most observers assumed the system remained healthy. But commodity systems do not fail gradually. They absorb stress until a threshold is reached. History offers examples. In the late 1970s, inflation surged globally. Confidence in fiat currency weakened. Precious metals rallied sharply. Silver, in particular, experienced extreme volatility. That episode is often remembered for its dramatic price spike and collapse. But beneath the headlines, it revealed something deeper. When large holders demand physical delivery, paper markets face limits. Exchanges responded by adjusting rules. Margin requirements increased. Trading conditions changed. The system protected itself. The lesson was not that silver is inherently unstable. It was that financial markets prioritize continuity over contractual purity. After that episode, silver entered a long period of relative quiet. Prices remained subdued. Futures markets expanded. Financial innovation accelerated. But the underlying structure did not fundamentally change. Paper claims continued to multiply. Physical inventories remained finite. As long as physical supply was sufficient, the imbalance remained theoretical. The early 21st century brought new dynamics. Globalization integrated supply chains. Just-in-time manufacturing reduced inventories. Efficiency replaced redundancy. This increased vulnerability. At the same time, geopolitical fragmentation returned. Trade disputes, sanctions, and strategic competition reshaped commodity flows. Countries reassessed reliance on global markets for critical materials. Precious metals regained strategic importance, not as currency replacements, but as reserves, hedges, and insurance. Silver's dual role complicated matters. It was no longer just a monetary metal. It was a critical industrial input. When strategic considerations intersect with industrial necessity, availability becomes political. In recent years, some countries increased domestic stockpiling of key commodities. Others restricted exports. Still others encouraged local processing and reserves. None of this required coordination. Incentives aligned naturally. Against this backdrop, the late 2024 inventory drawdowns take on greater significance. They were not isolated withdrawals. They reflected broader shifts in behavior. When physical silver leaves exchange vaults, it often moves to private storage, industrial use, or sovereign reserves. Once moved, it is unlikely to return quickly. At the same time, futures markets continued to trade large volumes. Open interest remained high. Paper exposure far exceeded available registered inventory. This imbalance is not unusual. It exists in many commodities. But it becomes problematic when delivery demand increases. Backwardation is one symptom. Rising premiums for physical metal are another. Lengthening delivery times are a third. These signals appeared quietly, often dismissed as temporary. But markets have memory. Patterns repeat. What makes the current environment different from past episodes is the number of reinforcing pressures. Industrial demand is not cyclical in the traditional sense. It is structural. Electrification and digitalization are long-term trends. Mining supply cannot respond quickly. Capital cycles are long. Regulatory processes are slow. Geopolitical uncertainty encourages stockpiling. Trust in paper claims weakens during periods of fragmentation. In such conditions, the margin for error shrinks. This does not guarantee dramatic outcomes. Markets can adapt. Substitutes can emerge. Efficiency can improve. But adaptation requires time, and time is what tight inventories eliminate. When supply buffers disappear, small disruptions have outsized effects. That is why observers focus not on price alone, but on availability. Price can be managed temporarily through financial mechanisms. Availability cannot. Which brings us to the central question. What happens if physical demand continues to rise, while available inventories continue to fall? The answer is not singular. Multiple paths exist. Exchanges can raise margin requirements, discouraging speculative positions. They can alter delivery rules, encouraging cash settlement. Governments can release reserves or adjust policies. All of these actions can delay outcomes. But they do not create metal. Ultimately, commodities obey physical constraints. Silver cannot be printed. It must be mined. And that reality shapes every possible scenario. At this stage, it is important to avoid extremes. Commodity markets rarely end in total collapse. More often, they transition through phases: tightness, volatility, adjustment, and rebalancing. The silver market today appears to be moving from surplus into tightness. Tightness does not mean absence. It means reduced flexibility. When flexibility declines, participants behave differently. Industrial users prioritize supply security over price. Investors differentiate between exposure and possession. Policymakers monitor strategic vulnerabilities. These shifts are already visible. Industrial buyers increasingly seek long-term contracts. Some explore alternative materials, though performance trade-offs limit options. Recycling efforts intensify, but scale remains limited. Investors become more selective. Physical premiums rise relative to paper prices. Delivery times lengthen. Financial markets respond with caution. Volatility increases. Liquidity becomes episodic. None of this implies inevitability. It implies sensitivity. In such environments, narratives often oversimplified. Claims of manipulation, collapse, or conspiracy attract attention, but reality is usually more complex. Markets are shaped by incentives, not coordination. Central banks prioritize currency stability. Exchanges prioritize continuity. Banks prioritize risk management. Governments prioritize security. These priorities sometimes conflict with price discovery. Sometimes they align. Silver sits at the intersection of these forces. Its monetary history makes it symbolically sensitive. Its industrial role makes it practically indispensable. That combination ensures attention during periods of transition. Looking forward, several outcomes are possible. Mining investment could increase, bringing new supply online over time. Technological innovation could reduce silver intensity in certain applications. Recycling could improve. Alternatively, demand could outpace adaptation, keeping inventories tight and premiums elevated. Financial markets could continue to function smoothly, with adjustments absorbed gradually. Or they could experience episodic stress during periods of delivery demand. What is unlikely is a return to effortless surplus in the near term. The world is changing. Supply chains are fragmenting. Strategic considerations are re-emerging. Efficiency is being balanced against resilience. In such a world, physical commodities regain importance. Silver's story is not about profit or panic. It is about structure. It is about what happens when systems built for abundance encounter limits. It is about the difference between promises and possession. And it is about how old materials continue to reveal the boundaries of modern finance. History suggests that transitions are rarely smooth. They unfold unevenly, with periods of calm punctuated by adjustment. Those who understand structure navigate transitions better than those who chase headlines. Silver has played this role before, not as a cause, but as a signal. It does not announce outcomes. It reflects conditions. And right now, the conditions suggest a system under quiet strain. Not broken, not collapsing, but changing. And change, in markets, as in history, always begins before it is widely acknowledged.